Many of you have asked me for an update on Netflix stock. The stock went down 10% after reporting earnings. Many investors believe it was due to the executive leaving the company, but I believe there's a much deeper question that the market is asking, and this is why Netflix is down 10%. So I'm going to talk about the stock again and let you know if I believe this is a buying opportunity or if maybe the stock is still overvalued and if we should wait for a lower price. So I really hope you enjoy it as always. Now, the company has actually reported really good numbers. They reported revenues of 12.2 billion and they beat the expectations on revenues. Earnings per share was not bad at all. They also guided second quarter revenue growth of about 13%. Now, this is one of the concerns, I would say. And they said it was due to the timing of title launches. And they said that the second quarter is expected to have a higher year-over-year growth. Now, the market is not buying it. If you look at the quarterly expectations from the analysts, they're expecting a massive deceleration in growth from 17%, 16%. Next quarter is expected to be 13%. 12%, 12%, and all the way down to potentially 11% by June of 2027. So once a company starts to decelerate in growth, the high multiple like for Netflix, it starts to come under pressure. And the biggest question is, why are analysts expecting the company to start to deteriorate in revenue growth? Some of it has to do with the company becoming larger and larger, but a lot of it has to do with the acquisition of Warner Brothers Discovery, which it didn't happen, and then they got a breakup fee of like 2.6 billion, and that's really amazing. But the main question is, why was Netflix going to acquire WBD? Normally when a company starts to do acquisitions and they don't never done acquisitions before, it's generally due to the core business slowing down in revenue growth. So if the core business is deteriorating, the company will try to mask it off by doing an acquisition. This is kind of what Celsius Energy has done. Celsius Energy drinks, the brand has peaked. Then they acquired Alani Nu, and Alani Nu boosted them. Then they acquired Rockstar, and Rockstar boosted them further. And now the stock is correcting because the core business is still weak. And a lot of investors are fearful that this is maybe what's happening to Netflix. So maybe Netflix's growth is nearing its peak, so the growth is going to decelerate. So the company was trying to do acquisitions. But this is not what the CEO said. He said, I just want to remind you that we said this from the beginning. The WBD deal was a nice to have, not a need to have. And Netflix has to prove itself to the market that the revenue growth has not peaked, it's still sustainable, and it's not going to depend on mergers and acquisitions for growth. And this is very, very key, I would say, to turn the company around and to get back to the previous multiples of where Netflix used to trade at before. Now, if you look at the percentage market share in terms of streaming, in the United States, Google, or I should say YouTube, has gained massive market share over the last year or so from 10% to 12%. And Netflix has been flat. It's even been flat for the last 2 to 3 years. The biggest problem for Netflix is the churn. So a lot of people sign up for Netflix, they watch the movie, they watch the show. Once the show is over, they unsubscribe, and then maybe they subscribe again in the future. If there's some kind of a new show that their friends and everyone's excited about, then they unsubscribe again. Now, Netflix found a very interesting fix to this problem, and this is getting into sports and live events. Now, let's say you're a sports fan, WWE, or you like to watch football or whatever you like to watch. If you can watch them on Netflix, you're gonna wait for the next match. Because let's say you watch the movie on Netflix, like, okay, there's a match coming up, I can watch it on Netflix, I'm gonna keep Netflix until the match. And after the match, there's gonna be another match, maybe a boxing match, maybe something else. So if you have something to look forward to, you're more likely going to keep your subscription. So with Netflix, it wasn't much about the growth. It was more about the churn. Now we're getting the churn under control, which could potentially boost subscriber growth, especially as the company is focusing more and more on the ads business and on lower tiered pricing kind of businesses. But it's still, again, an amazing business, very efficient business. They have grown their operating margins, or I should say net income margins, from 1% to 28%, and the company keeps on expanding them. So it's been absolutely stunning to watch. Now, if you look at the company's buyback program, they've actually been buying back a lot of stock recently, about 2 to 3% a year. So maybe not a lot, but they've been buying. They paused the buyback program when they were acquiring WBD. I believe they will most likely resume the buyback program very, very soon, and that will also help the stock, and it's great for shareholders. It's much better than doing dividends. I would much rather Netflix be doing buybacks, especially at current valuations. Now, if you look at the company's multiple on a forward basis, it's now trading at 29 times forward earnings. 29 PE, in my opinion, is still extremely high for a company like Netflix. I mean, imagine how many amazing companies you can buy for under 29 times earnings. You could buy Meta at 22 times earnings. You could buy Alphabet and own SpaceX and all of that for like 27 times earnings. You can buy Microsoft at about 24 times earnings. You can buy so many amazing companies with a similar growth profile, I would argue, and Netflix is expected again to decelerate in revenue growth. You have Meta growing revenues 22%. You have WhatsApp and Facebook and access to 3.5 billion people daily, and even Meta, after the recovery, it's trading at 22 times. So why would you pay up 29 times forward earnings for a company like Netflix? I believe the valuation is extended, but this is my valuation model on Netflix. I use current earnings per share of 258. I use 15% CAGR for the next 5 years. I believe this is fair for earnings per share growth for Netflix. Most of the earnings per share growth has been coming up very high due to the margin expansion, but the margin has expanded again from 1% to 28.5%. So expecting further margin expansion in the future, I think would be a little bit foolish. And I would much rather match the estimates with revenue growth rather than a massive delta on it just due to a potential margin expansion. So revenue growth has been 15, 16%, 11%. I put in 15% earnings per share growth. The trailing PE right now is at 31 times. I kept it at 31 times. All in all, without the dividend, that's actually a little bit, I should remove the dividend because they don't pay a dividend. But in total, I'm getting about 66% on the upside, or like a 10% annual return if you buy Netflix today. If you want to get a double on this case scenario, you'd have to buy Netflix under $80 per share, and that has been my fair value all along. Now, if you want to use something a little bit more, you could say optimistic, and I'm using again 31 times trailing, the company's average earnings per share multiple is something like 39 times. So if you want to use 39 times, which again is like the absolute best case scenario, then Netflix could be a buy today, but I still don't see more than a 16% annual return. So I believe Netflix is overvalued. I like Netflix around $80, close $80, $85. I think it's fairly valued. Here, I think it's expensive, especially relative to other stocks in the market. And that's my opinion on Netflix. Hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.